The Fed just paused rates at 3.5%. I am pulling $50,000 out of my savings account today. Here is exactly why. What's up, guys? It's your boy here, and if you've been watching the news this week, you already know. The Federal Reserve just wrapped up their March meeting yesterday, and they held rates steady at that 3.5 to 3.75% range. No cut, straight pause. Second meeting in a row they've done this. And yeah, they still say maybe one cut later this year. But for right now, they're hitting the brakes. So I sat down this morning, looked at my own numbers, and I'm done waiting. I'm transferring 50 grand out of my high-yield savings account before the rates start sliding. And in the next 10 minutes, I'm going to show you exactly why this move makes sense, where every single dollar is going, and the 3-step plan you can copy in under 30 minutes flat. Stick with me, this one's important. First, let's talk about what this Fed pause actually means for your savings account going forward. The Federal Reserve controls the short-term borrowing rate that banks use to set their own interest rates. When they announce a pause on rate cuts like this, it sends a very clear and urgent signal to the entire banking industry. Thus, the golden era of super high yields on savings accounts is starting to slow down dramatically. Banks have been offering these attractive rates because they could borrow money cheaply from the Fed during the high-rate environment. But now, with the pause in place, that easy money policy is shifting. Right now, the best high-yield savings accounts, HYSAs, are still paying around 4%. And if you shop around aggressively, you might even find some offering 4.3% or 4.5% APY temporarily. These rates feel pretty good compared to the old days of 0.01%. However, banks don't keep those generous rates forever once the Fed signals that cuts are on hold or slowing. They follow the Fed's moves like clockwork because their own funding costs are directly tied to it. Most financial experts, economists, and even bank insiders are predicting that we could see savings yields drop by a full percentage point, or even more over the next 6 to 12 months as banks gradually adjust downward to protect their margins. That means if you leave your hard-earned cash just sitting there in a standard high-yield savings account, the money you thought was finally working for you is actually about to start earning less and less with every passing month. Think about it. Your interest payments could shrink noticeably by next quarter. Meanwhile, inflation is still hovering around 2.7% according to the latest official numbers from the Bureau of Labor Statistics. When you subtract that inflation from your shrinking yield, your real return after inflation starts disappearing fast. In fact, it could turn negative in real terms very soon. That's actual purchasing power you're losing. Money you're literally leaving on the table every single day you delay. On $50,000, even a 0.5% drop means $250 less per year in your pocket. And over 2 years, that adds up to real money you can't get back. I've been there myself, and it's frustrating. Last year, my savings account was printing almost 5% with almost no effort. It felt like free money. Now it's already dipped down to around 4.1%, and I can see the writing on the wall. I'm not the type to sit on my hands and wait for it to fall another 0.5% or more while inflation keeps chipping away at my wealth. That's exactly why holding large amounts of cash in a regular high-yield savings account right now feels like the wrong strategic move. Yes, it's safe and FDIC insured. Sure, nobody is arguing against the security, but it's simply not smart or optimal when interest rates are clearly about to trend downward in a sustained way. I've watched my monthly interest credits shrink already, and I refuse to lose another $500 to $1,000 annually just because I was too lazy to move. So here's exactly where my $50,000 is going instead. After running all the numbers and stress testing different scenarios, I'm splitting it 3 smart ways that balance maximum safety, locked-in higher yields, and some flexibility for future opportunities. First portion, about $20,000, Colonius is going straight into longer-term certificates of deposit, CDs, from highly rated banks and credit unions. These let me lock in current rates around 4.5% to 5% for 12 to 24 months. This way, no matter what the Fed does next, that money keeps earning strong returns without me worrying about monthly rate drops. It's the ultimate safety net with guaranteed returns and zero market risk. The second chunk of $20,000 is headed into U.S. Treasury securities, specifically a ladder of Treasury bills and notes. These are backed by the full faith and credit of the U.S. government, making them essentially risk-free. I can get competitive yields that often beat savings accounts in this environment. Plus, they offer excellent liquidity if I need to sell early. Treasuries also have some nice tax advantages at the state level, which adds a little extra boost to my net return. Finally, the remaining $10,000 is going into a diversified mix of high-quality, dividend-paying ETFs and individual blue-chip stocks with strong histories of increasing dividends. This gives me that extra yield potential. We're talking 4% to 6% dividend yields in solid companies, along with flexibility and growth potential if the market performs well. It adds that little bit of upside while keeping overall risk manageable and still giving me peace of mind. This three-way split isn't random. It's a deliberate strategy I've refined after months of research and watching how rates move. And here's the simple three-step plan you can copy in under 30 minutes flat to do the exact same thing with your own money. Step 1. Open or log into accounts at a reputable brokerage or bank that offers CDs, treasuries, and brokerage services. Compare current rates using sites like Bankrate or TreasuryDirect.gov. It takes maybe 10 minutes and gives you the exact APY numbers to beat your current HYSA. Step 2. Calculate your split based on your risk tolerance. Maybe 40% CDs for safety, 40% treasuries for steady yield, and 20% into dividend investments for growth. Transfer the funds electronically, usually free and instant, and set up the purchases right there. Step 3. Set calendar reminders to review everything in 6 months and ladder your investments so you always have money coming due when you might need cash. This keeps everything rolling without you having to think about it daily. By making this move now, you're protecting your money from the coming rate slide and positioning yourself to earn better returns, even as the economy shifts. Don't wait until your bank drops your rate and you realize you lost hundreds or even thousands in potential earnings. The time to act is right now, before the window closes. If you've got cash sitting in a HYSA, take a look at your own numbers today like I did. You might be surprised at how much this decision could mean for your financial future over the next year. This isn't about chasing crazy high-risk investments. It's about being proactive and smart with your money in a changing rate environment. I've already moved my 50 grand, and I'm sleeping better knowing it's working harder for me. Now it's your turn. Take action today and thank yourself later. First $20,000 is going into short-term T-bills yielding around 3.7%. These are 100% U.S. government-backed, state tax-free, and lock your rate until maturity. Next $10,000 is going into I-bonds at 4.03%. These inflation-protected bonds adjust every 6 months, and I'm maxing my annual limit before the May rate drops. The final $20,000 is going into my brokerage account, a Treasury ETF and high-yield money market fund for instant liquidity at 3.6 to 3.8% with zero effort and strong safety. Total breakdown: $20,000 in T-bills for locked-in safety, $10,000 in I-bonds for inflation armor, and $20,000 in the brokerage for flexibility. All still super safe, all still earning solid money, but now I'm protected when the Fed eventually cuts again. All right, here's the exact 3-step plan anyone watching can copy in under 30 minutes. I literally did this yesterday. Step 1. Open the accounts. Go to TreasuryDirect.gov. Takes 5 minutes, link your bank. Then log into your existing brokerage. Fidelity, Vanguard, Schwab, whatever you already have. Or open one if you don't. Boom, done. Step 2. Transfer the money. Log into your current bank. Do an ACH transfer to the new accounts. It's free, takes 1 to 3 days to settle, but you can start the process right now while you watch this. Step 3. Buy. In Treasury Direct, buy your I-bonds and schedule your T-bill purchases at the next auction. In the brokerage, just park the cash in the Treasury ETF or money market option. It happens instantly. Total time? Under 30 minutes of actual clicking. The transfers do the waiting for you. Now, quick warning. Here's the mistake most people make when rates shift like this. They either freak out and do nothing, leaving the cash in a savings account that's about to pay less, or they swing the other way and dump everything into the stock market thinking rates are falling, so stocks will moon. Both are wrong. Don't chase the absolute highest rate and ignore safety, and don't turn safe cash into risky bets. That's how people lose sleep and lose money. Me? I'm keeping it boring but smart. 50 grand working harder, safer, and locked in before the next drop. If you've got cash sitting in a savings account right now, pause this video, go do the 3 steps I just showed you. Drop a comment below and tell me how much you're moving. I read every single one. And if this video helped, smash that like button and subscribe because we're breaking down every big money move in real time. I'll see you in the next one. Now, go protect that money.